Good evening, investors. I unexpectedly I'm going to provide you with an update on DGOC. I did not expect to post an update right now. I thought it was going to be on the 15th of April on their shareholders meeting, but that's not the case because they just announced that they are possibly acquiring new fields or new assets. And these are both upstream and midstream assets. So I want to walk you through it and I want to tell you why I think this is very interesting. And I also want to tell you how it's going to look compared to my estimations in my part 5 about the fair value basically. So yeah, we're just going to go through it. This is just going to be going through the text file. Once they have finalized this acquisition, I will go through the financial part of it and I will do the calculations again based on what we can expect from dividend, the growth, and so on, and how healthy the company still is, and basically all that. But for now, let's go through the statement. So I have highlighted a few parts, but what it basically says here is DGO enters into a conditional purchase and sale agreement to acquire Appalachia assets. This is basically the assets they have been constantly acquiring, so they're staying in the same area, which is positive, but we'll get to that later. Well, this part is just the introduction, basically how what we already know about DGOC, and what they here say is they are pleased to announce that it has signed a conditional purchase and sale agreement, the agreement, to acquire certain conventional Appalachian upstream and midstream assets. I actually meant to highlight all of this, but for some reason I forgot. I guess I got too excited to tell you about this, so my apologies for this. And they are going to acquire it from Carbon Energy Corporation. And I checked, this is also a publicly traded company, and this company is currently trading with a market cap of about 25 million, I believe. So it's a very small company. So the amount that they're going to pay for this is probably going to be a lot for them. But the deal seems very lucrative to DGOC. While the company can provide no certainty that it will complete the transaction, and that is also why I said I will do the calculations once it's definitive, DGOC continues to negotiate the terms of the agreement. The transaction is subject to ongoing due diligence, what a word, 2 words actually, which DGOC will complete to its satisfaction prior to confirming the final terms, including the gross purchase price, which is expected to be approximate $110 million. And this is an important part, 110 million. And obviously this could vary still a bit, so take it with a grain of salt. But this is an important aspect to see if this is going to be a lucrative deal. And something else that they mentioned at the end is, importantly, the transaction falls within the company's stated valuation criteria of less than 4 times EBITDA based on diligence to date, and will have an effective date of 1st of January 2020 if completed. So what does this part mean? Valuation criteria of less than 4 times EBITDA. What that means is that what they expect to pay for this acquisition, they expect to have the amount paid back in the form of EBITDA, so earnings before interest, taxes, depreciation, and amortization, in 4 years. So that is like a 25% return that they expect of this acquisition. That is based on the complete acquisition as far as I can tell, but hopefully once this becomes final, we'll be able to tell more about it. But this alone already states or tells us that this is a pretty good deal. Like, you can't complain when you get a deal like this, but we're going to get to it later as well in the production part. So the assets are located within DGO's existing West Virginia, Kentucky, and Tennessee footprint and further increases operating scale, this is important, and efficiencies. This is basically economy of scale. So the more they can produce, the lower cost, etc., etc. So this is basically playing into their own policies and the healthiness and the growth of the company. First point, mature low decline conventional net daily production in 2019 of 4,000 million cubic feet equivalent, or about let's say 10,000 barrels of oil equivalent, and it's 97% natural gas. And yeah, these are the amount of wells. But this part, 9.900 barrels of oil equivalent, we'll get to that in the calculation as well, but this is basically a 10% growth of their current production. And if you think back about my final video, I did an estimation of, okay, they have their debt a little over 200 million. If they constantly use that and they stay within their leverage ratio, they can grow annually about 15% per year. Annually, as I said. So what does this mean? They pay 110 million for a growth of 10%, whereas I would have expected a 210 million for a 15% growth. So this is basically a discount of like 50 million in comparison. So this alone is already very interesting. But the second point, intrastate gathering pipeline of approximately 4,700 miles in West Virginia, which currently transport the majority of the production from Carbon's Appalachia wells and provides additional third-party transportation revenue. And this is something that I talked about in the videos as well, how their costs are higher when they have to use the third-party transportation. They are basically becoming the third-party transportation right now, and they won't have to pay that fee for the third-party transportation. What will happen is that their capital expenditures will probably increase because they will need to maintain these assets, but almost 5,000 miles of increase. I believe there was about 12,000 miles that they had as of 2019, or let's say 13,000 to be on the safe side. So this is approximately an increase of 25-30% of asset increase. At this price, it is insane. It is a very lucrative, very good deal if it goes through like this. And even if they add 10 million in the cost price, which I don't expect if the deal goes through, it is still a very good deal. Third point, 2 active natural gas storage fields that generate third-party storage revenue and greater control optionality for DGO. So I highlighted third party again, storage revenue. Again, I forgot to highlight this. So excited to send this video, I guess. And what this means is, well, they have actually another way of generating some revenue. I don't think this is impactful in any way, but all the gas producers have their gas production wells open, and they're trying to produce as much as possible because they need to stay afloat. So there's going to be a lot of excess gas, and if it needs to be stored in a field, I don't actually know how that works. It seems a bit weird to store gas in a field, but seems like it works like that based on this point. So that's some extra revenue that will include or will come to DGO. So final point, robust hedge portfolio that includes an average NYMEX downside protection of approximately $2.60 MMBTU for a period of 18 months, and this will basically hedge 75% of their portfolio. So I didn't know this, but when they are, at least in this deal, when they are acquiring the production, they are also taking over the contracts that the current company, so Carbon, Carbon Corporation, has with whatever bank or institute they had a contract with. So they take over the contracts, and they are actually able to produce with the new assets at these prices already, which is obviously pretty good, because if they had to buy it and then produce at the current prices, which is about, 180, it's not going to be as lucrative as a production. But to also take these contracts is actually very interesting, and it makes sense as well, because the current company is not going to be able to produce so much gas anymore, so they want to get rid of those contracts as well. So I think maybe actually they got these contracts at a discount as well because of that. because they would normally hedge at around 270, so they might not be the happiest about the 260 hedge. So it could be that they actually got a discount on that as well. Obviously, we don't know that because we just see the 110 million price, and that includes everything, but looks good. So this is the third part. I have 4 parts, by the way. And yeah, here they state pretty basic stuff. It is I highlighted this part, and why did I highlight this? Because here it states with funds available on its existing revolving bank facility or similar financing. So how are they going to finance this? With funds that are available. In the past, they needed both funds like loans, and they needed to obtain money through share dilution. So in this case, they can just pay it with borrowed money and then start paying it off again. So this is a non-dilutive growth, and it will enhance the accretion to the dividend while maintaining leverage below 2.4, and we know that they maximum go to 2.5. This is an increase of 0.1, so they could acquire something like this again this year, which is very interesting as well. But yeah, so we don't have to worry about a possible share dilution that our net worth is going to get worse because of an acquisition. This is, I believe, one of the first ones, or actually one of the first one that has such a potential high growth that will not dilute the shares. So that's positive. And then the final part, this is what CEO Rusty Hutson Jr. said. Well, he's basically stating what we already know, is that DGO is uniquely positioned to capitalize on compelling opportunities in the current market and moved quickly to secure exclusivity on this value accretive package. So what does this basically, why did I highlight this part, this value accretive package? I don't know if I pronounced that right, accretive, but seems, let me know in the comments, I don't know. And they moved quickly to secure it, so this is probably a once-in-a-lifetime opportunity to acquire it at this price, and it seems like that. And I don't think there's a lot of other companies in the area that are looking to acquire more assets because they are barely managing to stay afloat at this point, so they need every penny they can get to stay alive as a company. So this is a very good deal. We can comfortably fund the acquisition without dilution, which we just talked about. So, and here it just basically shares, you can just read it all that you want, but this is all we know already. Smarter well management across additional assets, drive operating efficiencies and cost savings. This is obviously very important, but we already know that they do this and we have seen it already. So he is just being open about it. So they expanded the scale, and they will enhance operating margins. And something else that I found interesting to read is their resilience. It will provide additional insulation and resilience in this low commodity price environment. Again, I forgot to highlight this one. What did I do? Ridiculous. But I did not expect that they would view it like this, but it makes sense because yeah, you acquire something and you can produce more and you have more income, also more cost, but with those low costs it is always good to acquire more stuff in these circumstances. So it's looks all great. That's why I'm so excited about it, I guess. Further expanding our midstream system will provide both greater certainty, and this is what I talked about in one of the videos as well, that they have to pay third parties for transportation. Now that they own it themselves, they do not have to pay that anymore. They just have the maintenance, and they can pretty much control that. And they have the optionality to transporting our production. And together with the storage fields provides ways to generate additional third-party revenue. We talked about this already. This proposed complementary acquisition, if completed, and remains consistent with our commitment to pursue prudent growth, and this is probably what you guys like the most, that enhances our dividend per share to shareholders. And what is interesting, if we, like, just a broad statement from me, if there is about 10% production growth on average, I think I think it could be a little bit more. Well, on average, I think their dividend will increase by 10% once they have acquired this. And that means that we will go from 0.14 cents to about 0.155 or something like that. And I'm pretty sure that everybody who has been buying DGOC based on my videos has a better price than me. So your dividend yield is going to go up by 10%. And yeah, not much more to it. I believe that the share price will also increase because of this. My initial valuation of the company that was the defensive one, that one will increase as well by 10%. And the growth one, I would not adjust that one because this is basically part of that valuation. So if you think that that would also increase, then be careful because this is something that I calculated in the growth valuation, and that is basically the most difficult valuation that I did in part 5 of the video. I showed two valuations, a defensive one and a growth one, and this whole video basically shows that the growth one is actually a viable opportunity or a viable valuation, and the growth may be a bit on the safe side. I did not expect them to be able to acquire such a cheap assets, midstream assets and upstream assets. So that could mean that in the near future the growth could be a little bit more, but for now I'd stay on the safe side and stick to that valuation. And yeah, in 10 years it's going to be about 10 times, no, not anymore now, it's going to be like 7 times more than the current price, give or take. So that's it for today. That's the update. I expect to do DGOC updates every time I see something like this. When the official announcement comes that they have acquired this, I will use all that information again to make new calculations and to see if it is as great, like the 4 times EBITDA part and so on, as we should expect. That's something then we know that the management is honest and stuff like that. So I'll be looking more into that when the deal is finalized, and if any other updates come, I will make sure to let you know as well. So hope you guys enjoyed it. If you have acquired DGOC because of my videos, make sure to leave a like and subscribe. I always forget to say that, so I thought I'd do it now. And for now, have a nice evening.